I think I can make the weekend report pretty quick since we've covered most of the stuff on the multiple reports Friday. Um, Starting with the stock market, there's nothing here that would suggest to me that this is a continuation of this intermediate cycle here. This just does not look like a bounce that is going to roll over and give us a week 30, 32, whatever intermediate cycle low. This has all of the earmarks of a completed intermediate cycle low, and we knew this was a possibility. That the central banks are going to protect the stock market. It's especially important right now. The economies are weak, and the way to prevent recessions or moderate them is to make sure the stock market is rising. So they're going to throw everything they have at stocks to keep the stock market rising. It will make the recession end sooner or make it much milder than it would be normally. Moving to the weekly chart, there's just no way that I can look at this and say this is a counter trend bounce that's going to roll over and continue this already fairly long intermediate cycle. And we've recovered the 10-week moving average and done it forcefully this week. So again, the original plan was if you wanted some insurance, then take a partial position in unleveraged funds. My suggestion was QQQ or SOXX. And then once we get the intermediate cycle low, you can either add to that position or you can convert it to some leverage. Don't go crazy on leverage. Again, like I've said, there's a possibility that we could get some volatility in here between now and the election. So don't be so heavily leveraged that some volatile wiggles will knock you off the trade. But I think the important consideration is to stay focused on this weekly chart, and until something tells me different, I have to assume that we are on week 2 of a new intermediate cycle, and we're probably going to rally for anywhere from 15 to 20 weeks before this intermediate cycle tops. So I would tend to want to ignore the volatility until we get much, much deeper into the intermediate cycle. So if you're using some options, you don't want to go out to November unless, of course, you're just willing to bet some money that you don't mind losing for the opportunity to get some huge, gigantic leverage. But you can't do that, obviously, with your entire portfolio. You can maybe do that with 1% of your portfolio. But for any money that you really want to play it much safer, you're going to have to go out to at least January, maybe even February or March. That gives you plenty of time to weather some back and forth volatility, just on the chance that maybe this first daily cycle ends up being choppy. Maybe I noted the possibility of maybe this turning into a triangle consolidation. So maybe we come up here and then come back, all the way back down here, and we've got some choppiness here. Just on the chance that could happen, give yourself plenty of time on those, on any call options you buy in the stock market. So, bottom line, there's just nothing here that would suggest to me that I need to be panicked about another leg down. This just looks like a completed intermediate cycle low. This looks like we're on week 2 of of the advancing phase of a new intermediate cycle. We had a very strong breadth thrust out of this bottom. The McClellan oscillator has delivered a strong push back above zero. That's indicative of an intermediate cycle low, and we've got this. Granted, this is the 3-day RSI, but this will lead to 5-day. So I'm assuming that what's happening here in the 3-day is also going to occur on the 5-day, and we're starting to get a kind of an embedded look on the RSI, and that is characteristic of the advancing phase of an intermediate cycle. All right, so now let's move on to gold. All right, so the same strategy we have employed on gold. I told people, if you're worried about the intermediate cycle bottoming sooner than we anticipate, buy some insurance, partial position in unleveraged funds. Once we get an intermediate cycle low, we can convert those or add to them. We convert to leverage or add to those positions. And yes, and like I said, this is why I don't suggest people sell short, because you get these unexpected bottoms, and if you aren't prepared for it, then you end up holding your short too long, and you get caught, and you just end up giving back all of your gains. I was not expecting a bottom this early in gold. I was expecting this to left translate, give us one more move down to 1800 or so. But I also did not anticipate that the dollar would crash through that 50-day moving average. So just because I was expecting a move to 1800, and most of the confirmations that we typically get at a intermediate cycle low have not and probably will not occur, it doesn't mean I'm going to ignore the signs that we've got an intermediate bottom. The simple fact is that we live in a world where governments intervene in basically all markets, and especially the currency markets. And it looks to me, let me go over to the that the Fed has broken this intermediate rally. Yes, it should have gone further. It should have broken the intermediate trend line. That is a confirmation that happens at 95% of all intermediate cycle lows. But it appears to me that the Fed's printing press is more powerful than the buying pressure coming out of this intermediate cycle low, and it just looks to me like they have stopped this rally dead in its tracks. If the dollar comes below this low right here, then we'll have another confirmation that they've stopped the intermediate rally, that this would be a lower low. As you can see, we just sliced right through the 50-day moving average today. That really should not be happening if we're still in the advancing phase of an intermediate cycle, and we're starting to get embedded on the 3-day RSI. Again, something that really shouldn't be happening if we're still in the advancing phase of an intermediate cycle. So while I don't think for a second that this would happen naturally, it clearly can and will happen in markets that are being heavily manipulated by governments. And central banks are printing just an insane amount of money, and the Fed wants the dollar going down. It'll keep risk assets, specifically the stock market, going up. So apparently their printing press is stronger than the buying pressure of this intermediate cycle. So I'm not going to look at this chart and try and squint hard enough to see something that isn't there. The fact is that price has broken through that 50-day moving average, and it really shouldn't do that. All right, going back to gold. So, I showed this, let me widen this. I showed this trend line in the morning report, and I've said it again. There are multiple reasons why I would expect another leg lower. The COT isn't all that bullish. We haven't broken below the 100-day moving average. Sentiment never really got bearish, but none of that really matters if the intermediate trend line is broken and if the Fed has been able to break the dollar rally. And so I'm forced to view the market as it is rather than how I think it should be. We really should come down and make a lower low and probably test 1800, but we really should not be breaking this intermediate trend line if we've got a final if we are going to left translate this cycle and move down, one more failed daily cycle. And we did complete all of the requirements. We did have one failed daily cycle. This one moved slightly below that. We did manage to turn the 10-week moving average back down marginally. We did break the intermediate uptrend line. So other than the fact that we just really haven't cleared sentiment and a few of the other, that 100-day moving average didn't break, and we didn't get the weekly stochastics oversold. Other than we haven't completed some of those requirements that I would like to see fulfilled, we did actually complete all of the absolute necessary requirements, and this did come down to test the 38% Fibonacci retracement. So we actually did complete every requirement that's I consider an absolute necessity before I want to try and call a bottom. We just didn't complete some of those secondary parameters that I would quote unquote prefer to see before I try and call a bottom. But at this point, we've broken the intermediate trend line. This seems like a pretty strong impulsive move. I'll go to silver. This just seems like a pretty strong impulsive move here, and this just doesn't. Also, we're starting to embed the 3-day RSI here, and this just doesn't. At this point, this doesn't look like a daily cycle that is going to all of a sudden roll over and left translate. This looks like we are in a first daily cycle, and it looks like gold is going to follow the stock market. The stock market is, clearly, in my opinion, completed an intermediate cycle low, and gold is following stocks, and probably for the same reason that the central bank has broken the rally in the dollar, and it looks to me like we're probably going to start the next leg down, and I expect this leg down in the dollar will find that final 3-year cycle low sometime in the spring. So stocks, to me anyway, look like they are anticipating that, and they are going higher. And now it looks like gold has caught the clue as well with the break of the 50-day moving average on the dollar, and it looks like to me now that gold has also decided that it's going to follow the stock market higher, and probably for the same reason. So again, we've got our strategy in place. As far as I can tell right now, it's time to add to that position, that unleveraged position, and if you want to convert some of that unleveraged position to leverage, now's the time to do it, I think. Yeah, if you're going to buy options, buy some extra time, just in case we're wrong and this does come back down and make a lower low. As long as you got plenty of time, then you don't need to panic, because we're still going to have an intermediate rally, and I'm convinced that the next intermediate rally is going to break that 1923 on a sustained basis and maybe go anywhere from 2,500 to 3,000. So even if this does do the unexpected and rolls over and left translates, it's going to be 27, 28 weeks into this intermediate cycle. So you've got to anticipate that any continuation of the intermediate cycle is going to be done pretty quickly, and then we should be off to the races. So just give yourself some extra time. My suggestion is at least out to January on any call options. That way you got plenty of time. If this daily cycle decides to throw us a curveball and somehow left translates and comes down and tags 1800, you still got plenty of time for that to finish, and then then we start the intermediate rally in earnest, and you'll be fine. You don't want to go to November or December just because there is a small chance that this could roll over and left translate and give us 1800, and at that point you might not have enough time to recover. So as far as I can see, intermediate cycle low is in. Now's the time to convert or add to those unleveraged positions that we've had, and any leverage that you're going to take, just give yourself a little extra time just in case this does roll over, or in case we've got to weather some volatility here between now and the election, or a little after the election. I mean, there's a chance that this first daily cycle could be rather volatile and more of a sideways basing pattern rather than just a rocket launch. So give yourself some extra time just in case that happens.